You're listening to UCW Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
Relax, editor. It's good.
You know what I mean?
Money to be made in a place like this. Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine my head.
You know what it takes to sell real estate?
It takes brass ball.
I'm falling, and I can't get up.
All right, welcome to Money Never Sleeps, and it's good to be back. We're going to be covering a lot more of the real estate arena in the coming segments, because as luxury and commercial real estate begins to boom or slide, it can give us some indication of the money flow. So that could be interesting. Now to start off, we've been hearing a lot about the inflow of Chinese, Russian, and even European money in the U.S. market over the past, gazillion years, both luxury, residential, and commercial. But there is a new player in town, and it's our neighbors to the north. The latest trend hitting the U.S. is Canadian money flowing into U.S. assets. That's right, Canada. Now, it's hitting the warmer climates such as Florida and California, but as the supply dries up, that money has to be put to work somewhere. Now, this is not just individuals that I'm talking about. I'm talking about private equity, the private equity market. With more and more private equity firms springing up globally, they're pulling on the purse strings of some of the wealthiest people in whatever country they're based out of. So Canada is no different. And in Canada, you have big money burning a hole in the pockets of investors because beyond the stock market, they have a short supply of real estate assets that they can get their hands on. And it's funny, in Europe, you'll see properties that have been held by a family for generation upon generation. But here in the U.S., it's a rarity because money talks and, how can I put it? Well, everything else walks the dog. So look for more and more Canadian dollars to flow into the U.S. real estate market, into U.S. real estate assets, and there's a lot of money to be made if you're looking in the right places. So that should be interesting. Now, the Blackstone Group. Well, what can I say about the Blackstone Group? Look, if you're playing a video game, let me paint the picture. If you're playing a video game, they would be Pac-Man. And the little itty-bitty ghosts floating around, they would be other private equity players in real estate and REITs. They have gobbled up, and I'm talking about devoured, a ton of residential assets over the past 18 months, and they are not limiting themselves to residential. Nah, not Blackstone. They are going after the big dogs and already inked a deal to acquire the shopping center assets of American Realty Capital Partners. But this one has a bit of a twist. The Blackstone group, they did something that is a little more Wall Street than real estate. They partnered with New York-based DDR for this acquisition, but it's a 95% split. So 95% for Blackstone, 5% for DDR. But the point is that I think that they did this to avoid a potential outcry that they're dominating the space, because out of all the private equity players out there, they probably have the most endless supply of cash on hand for them to do whatever they need to do. So as opposed to the outcry for them dominating the space and leaving little wiggle room for others to play in the sandbox, well, they're letting other people wet their beak, so to speak. I think this trend will continue, and it will continue to push commercial real estate rates. It'll continue to push them up, and sales prices up in the New York area. This is what I see happening, so stay tuned to that and just keep an eye out for what's happening in your area, especially if you're in New York. Now let's talk about Fannie Mae and Freddie Mac. Well, these two lending institutions, they were the biggest of the big, and they rose from the ashes after they got stomped and kicked around. They rose from the ashes like a phoenix, only now to face the battle of a lifetime, as banks are going head-to-head with them in the multi-family lending arena. That's right, they're not the only player in town. Now, the traditional banks, they're not just opening up their wallets and saying, hey, we're going to lend to you. They're doing this at rock bottom rates for those that can, that have the backing to do it. You're a good risk. They're going to roll with you. And this is going to make it hard for Fannie Mae and Freddie Mac to compete. So it's going to be extremely interesting to see where all of this winds up in the next 12 to 24 months as this trend continues. Now, for all you Hollywood buffs out there, I think this is pretty cool. Look, if you have a spare $12.5 million in your back pocket, then you can be the proud owner of the house from the Tom Hanks movie, The Money Pit. So if you're up for a ride to Lattingtown, New York, and that is in Long Island, just give the listing broker Sean Elliott of Sean Elliott Luxury Homes and Real Estate, actually Luxury Homes and Estates, give him a holler. He's sure to tell you the rich history of the 1898 house and how it became a real-life money pit. It's a whole story behind that, people. Now, moving to stocks. Two companies that I will tell you that are really, really up with the times and technology and whatnot. Look, Starbucks and Domino's. Believe it or not, these two companies have embraced technology. They dove right in head first. Starbucks has been implementing so much tech into their business model that it's raising the bar in that arena. And they're putting those pricey latte prices to some good use for their customers, because now customers can come in, they'll be able to charge their phone just by putting it on a counter. And much, much more is going to be coming down the pike, I'm sure of it. Domino's right now, they're using technology to make it even easier for their customers to order. They added voice recognition to their online ordering model, which is really interesting, and it could be a game changer if it catches on. And there has been a ton of opinions, ton of views and flack that came from the Elon Musk announcement. Unless you're sleeping for the past week, you would know that Elon Musk, he made an announcement that he's going to release all patents, well, not all, at least the ones for the electric car, to the entire auto industry. All right. Now, some people thought he was crazy. Some people thought he was this, that. Elon Musk said, you know what? If the board doesn't like it, they can fire me if they like to. That's how adamant he was about doing this. But honestly, it was genius. Think about this. Who wants to go and build out all these electric stations throughout the country or throughout the world? Do you think Tesla wants to do it themselves? I don't think so. So the more people playing in the game, the more stations will offer electric boosting. And that allows Tesla, which is the best in class in that arena, to go national, over time, go global with ease. And this may, fix that issue with them having to be, being able to sell directly to consumers. Maybe. I don't know. That's a story yet to be told. And I think that you're going to see more and more tech companies. We're going to another segment here. I think you're going to see more and more tech companies coming to the forefront in an effort to disrupt what's out there now. Now, the problem with this is this. You have a lot of good companies. that are coming out, good ideas. You know, I hate when people want to get paid for an idea they have. You know, implement it, create a company, do something with it. Anyway, so you have these innovative ideas. They're turning them into companies, and they're going out there raising capital. And the problem that I see is not what they're doing or how they're looking to disrupt what's out there now, because that's how growth happens. The problem that I see is that you have money flowing into the next big thing, but, and this is a big but, what the private equity investors and firms have done is that they make it much harder, believe it or not, much harder for companies that are outside of the Valley bubble or the who do know to fund me deal to actually raise capital needed to make a difference. You have a lot of good companies out there that are banging their head on the wall trying to get funding for projects that they're doing that are really fantastic. And the issue is that the private equity players, they're looking at the companies that are brought to them by people they know, that are brought to them by you know, again, by people they know. Or if they know something that's going on in the valley or something like that, hey, they will go and approach them. All right, so it makes it easier for those type of companies to actually get funding. You know, look, let the truth be told, I founded a tech company, okay, that had the initial steps in social media. But the plan was so innovative, it was so grand, but so possible. And it was meant to do some good out there. But firm after firm after firm said no, because, look, the company wasn't in that world. It wasn't in the world that they're used to. Now, and they didn't say no because they didn't like it. You know, quite the opposite. They liked it, but it was one thing or another. You know, they were invested in similar companies. That was a big thing. So it was a conflict of interest. However, you know, if the company was in the valley or the who do you know type of situation, it would have been easier to get, you know, these firms, and I'm not going to name names, but these firms actually pony up a couple of bucks to help the company get to where it needs to get to. Okay, but those same firms, they did go and fund companies that actually competed with major companies that they were heavily invested in. So that threw me off in a big way. You know, my point is we need to get an expert in raising capital for truly innovative companies on this show. Someone that won't look at for an upfront fee. Yeah, you know, those type of scoundrels out there that are looking for money up front and don't do much. You know, but, you know, someone that actually believes in the projects that they work with. So if anyone knows of someone like that, if they know of anyone like that does this, you know, please reach out to us. We not only would like to speak to them, we'd like to speak to the companies that they're helping, and bring them on the show so that we can speak about it, because I think that these things need to be spoken about. All right, now talking about tech, make sure to follow some awesome people on Twitter that know a thing or two about their business. You know, Pete Nigerian of CNBC's Fast Money and Option Monster. The guy is a trading machine. Good guy to follow on Twitter. John Fort and Carl Quintanilla, you know, these are two guys that are on fire with CNBC Squawk Alley, and they're tackling everything tech. You know, this is a new show that's going to get better and better and better. And I said it, I keep saying it, that they need their own set, high-tech set with technology integration and the whole 9 yards. Make it look, you know, futuristic. That would be the set that would attract a lot of the young people to actually watch the show. All right. Trish Reagan, you know, Bloomberg's TV, she brings it fast and furious in the world of business. And Dolly Lenz of Dolly Lenz Real Estate, she is by far the top tomato in the world of luxury real estate. You need a palace in the middle of the desert, then she's the person that will make it happen. So follow these great people, and every week we're going to mention new people that you should be in touch with. Now, with that said, I want to get to our special guest today, and we are going to talk about private equity. So without further ado, please welcome REO Capital CEO, John Dinest, to the show. John, welcome back to the show. It's been a while. How are you?
Very good, sir. Thank you very much, Lou, for having me, and I am glad to be back.
Well, I'm glad that you are back because, we have a lot of stuff that we need to kind of tackle.
Well, we can talk about a variety of different things within the private equity world and get everybody up to speed.
Well, let's rock and roll. Tell us what's going on in the world of private equity now.
Well, we're seeing a greater shift to an asset class that is becoming far more accepted in the world of alternative investments. In years prior, I think that the lockup of your investment for 5 years was kind of shunned, and really restricted because it was private investments to a select group of people. But today, it is recognized as more accepted asset class, and subsequently we are seeing a greater allocation to different sectors within private equity, whether it be from real estate on out to technology. And I think that there not only is it a more accepted asset class, obviously the IRRs are much greater than the equity markets or the bond markets of today. So we're seeing people like Harvard's endowment fund that normally would allocate 20% to alternatives, now allocating over 30% to alternatives, including private equity.
That's interesting.
To me, that kind of signifies that not only is it more acceptable, but I believe it's more than that. I think that what they are saying is they see the writing on the wall to a more tumultuous economic times, and subsequently they're preparing themselves for a greater alpha. So when the markets do correct themselves, they're going to be in a better position.
Okay, now this is not just happening here in the States. This is more of an international thing at this point.
That's correct.
Okay. Where, just out of curiosity, because you have your fingers on the pulse of what's going on in private equity, where do you see a lot of the money flowing from?
Well, a lot of money is flowing out of pensions into registered investment advisors. There is a greater shift of wealth going, and I've just written an article on my blog about that and how pensions are preparing themselves for any type of restructuring, and Detroit is a prime example of having to restructure their pension plan, and they've stated that Chicago is next, and also New York, Manhattan is following that, and if those guys don't work on restructuring those pensions, that they're going to be in economic turmoil as well. But people like CalPERS, I've seen distribute money to various registered investment advisors to manage a $500 million clean tech fund, for example, for a company out of La Jolla. They've been shifting some of that $300 billion or so, that AUM, into other areas of the marketplace to kind of mitigate that risk.
I always look at where the money's flowing out of and where it's flowing into, because it gives you a better idea of what can potentially happen in the next 12 to 18 months.
Right, and I do see money shifting into gold also. And I think that's a predictive index of the possible inflationary pressures. I see the government of India acquiring large quantities. I see Putin acquiring large quantities. I see the U.S. Federal Reserve acquiring large quantities. I see Paulson and Soros also buying large quantities, and they predict by the year 2016 we could see gold at $2,400 an ounce.
Well, I think, I mean, you know what I see? What I saw Klondike. I saw Klondike, I really did, honestly, I really did. It was about the gold rush. And that's pretty much what we're looking at here. You're talking about Klondike, the Yukon type of deal. You have, different, different countries going out there and acquiring gold. Could gold go to 2,400? It's possible. It's not going to be a straight run. That much I will tell you, and I stood to that.
Right.
I mean, because gold, I remember gold when it was in the 300s, and
Right.
it wasn't even worth it to pull it out of the ground.
Right. But I also see a shift there's plenty of deal flow, and I think what's stimulating the deal flow in private equity is this current administration on our part-time society in the jobs market, and so many small business owners, I think, are fed up with higher corporate taxes, higher personal taxes, and now higher healthcare taxes, that they're selling out, taking golden parachutes and parachuting out for 60 cents on the dollar of their companies. You see guys leaving Cerberus, leaving Apollo, leaving Carlyle, leaving Bain, all these large firms starting their own PE firms. And my own attorney tells me that he feels like a kid in the candy store who all he does is structure PE funds. And he says, I see so much deal flow out there. There's a plethora of deal flow, and there's no shortage of deal flow in the private equity markets. And he says, I don't see that stopping.
No, you know what? He may not be wrong on that, because earlier in the show I was talking about private equity and real estate, and there's a lot of inflow coming in from Canada. Believe it or not, into the real estate market. Because they when you have wealthy people, when you have individuals. I mean, the guidance they're getting is whatever they're getting that's in front of them. When you have a group of wealthy individuals invested into one private equity fund, well, guess what? Now you have some power. You look at a company like Blackstone. You look at all these major, private equity firms that are managing the money for some of the wealthiest people in the world. That says a lot, because they're putting their trust in whoever they're dealing with.
Right, and I see also within my own industry, I've talked to KKR, and I've also found out that a financial publisher is getting into the capital raising business. Blackstone acquired Park Hill Group years ago, so you got guys like KKR and other guys who are getting into the fundraising business. And I tell people, if it wasn't lucrative, you wouldn't see this phenomenon occurring.
Mm-mm.
And what's interesting in my world is that these guys, the Blackstones of the world, are not going after the $100 million to $500 million funds like I do.
No.
They're going after the $1 billion to $9 billion funds, and they're working on 30, 40 funds a year, so they're raking in well in excess of $800 million a year in revenues for capital raising. So I tell people, you don't have to invest in the next Snapchat to get a lucrative return on your investment, and all you have to do is look at the trends also within the financial service industry, and you'll see some pretty lucrative investments there.
Well, and look, you're looking at Blackstone. I mean, KKR, look, anyone that knows KKR, they know that they do not move a finger if it's not making them money. And it's not going to make them money.
I talked to George Roberts specifically, and George said to me, he says, we get asked all the time by private equity firms to help them raise capital for their funds. And he said, this is why we're looking at your distribution channels to raise capital and start our own capital raising division for these funds.
George Roberts is a legend in private equity.
Exactly.
The leveraged buyout arena, LBO.
Exactly. And I remember him with R.J.R. Nabisco.
Yep. Him and Henry Kravis.
These guys would not get into this sector within the private equity market if it wasn't lucrative, and I think also that serves as a gauge as to how much more accepted and how many more people are becoming involved, and that a whole expansion. Last year, there was 580 private equity funds alone, not venture capital, not hedge funds, just PE funds, that raised over $450 billion.
Wow.
Globally.
That's staggering.
$120 billion came from the U.S. alone.
That's staggering.
That's over a 33% increase over the year before.
Let me ask you a question, John, because, since you are the authority in private equity fundraising, you have a lot of funds that are overseas. And you have a lot of, U.S. funds that are going out there and they're creating funds overseas. And they're raising money overseas. Do you think that, why do you think that is? Maybe that's the question. Why do you think that they're doing that?
Well, you see a lot of expansion in healthcare and other sectors. And you're right, I see that in Canada. I see it in Europe. I'm looking at funds that are raising capital. There's a lot of mezzanine funds right now going on. There's also, I see an increase in global timber funds in the private equity sector. So besides the clean tech, I'm seeing that hard assets also on the rise. So I think that the economies are really looking at the sectors that are going to be, over the next few years that are going to be in favor economically, and I think they're taking into consideration what variables are going to happen. And as I mentioned to you before the show, I think that as Yellen slows down this bond buying program. She already did it in the first quarter. She went from $85 billion down to like $60 billion. And they said by the fourth quarter she's going to reduce it dramatically. And I don't know what that means. I don't know if that means $30 billion, $20 billion, $10 billion. I don't know what, but in my opinion, what that will signify is a correction in the equity markets and the bond markets. And, as we get a cold, the rest of the world gets the sniffles.
Right.
So I think that people might be looking at that as a way also to prepare themselves for what they need to do over this next 12 months.
No, they're looking at what we're doing as they're gauging what they need to do.
Correct.
Which is definitely interesting. So now moving forward. Okay, with Yellen, they're looking to exit that the bond buying situation. Do you think that beyond the market correcting, do you think that that's going to have a positive or negative impact on private equity itself?
A positive and negative impact on? I'm sorry.
On private equity itself.
I've told my wife the silver lining in the gray cloud, honey, is that as this economy goes into some phase of correction, you're going to see these portfolio managers look for that alpha, and they're going to search more over for private equity to make up that alpha. So the silver lining in the gray cloud is the transition is going to move away from the equity markets and bond markets and even greater into private equity.
With private equity, you could have more diversity. You definitely do have a lot more buying power. You can do a lot more because private equity is not just, and you can correct me if I'm wrong, because I just want people to really know this. They're not just invested in stocks. They're invested broad-based. Real estate, hard assets, commodities, this, that. It can be anything that makes a buck. And that's what the difference is.
And I tell people, If it wasn't for Mitt Romney, your kids would never be able to go to Staples and get discounted school supplies because of private equity and Bain Capital that took Staples public from a private company. Those are the type of progressions that you're going to see more of within private equity.
Mm-hmm.
And of course, we need more of that small business growth because in recent articles, matter of fact, from Forbes, they've described how business deaths are now outnumbering business births. So according to U.S. Census, we've crossed the line. In 2008, we had startups outpacing business failures by 100,000 per year. In the past 6 years, that's upside down. Now we have minus 70,000 business startups versus the survivors. So it is going into a phase where you're seeing this economic trend not progressing. They're talking about unemployment numbers still at 13.9%. It's not anywhere at 6.7 or 6.8%. GDP is still below 2%. And they're saying over the past 60 years that even Bush's failed economic policies, as was stated by the current administration, his recession only lasted 2.5 years. The past presidents of the last 60 years only lasted 2.5 years on their recessionary times. This administration is now into its 5.5 years now, and the recession has not progressed.
And right now, what do you think would be, in your opinion, would be the solution?
Well, I think that instead of focusing on tax and spend infrastructure, we need to focus on cutting taxes for the small business. 98% of all businesses out there are small businesses. Only 2% employ more than 100 people or more within those businesses. So really the backbone of America is really built on small business. And if we pay the highest corporate tax rate in the world. Nobody else charges a 35% corporate tax rate for small business, plus state tax, plus equipment tax. By the time you're done with all and healthcare tax, you're up over 50%.
Why do you think Pfizer wants to move to the UK?
At least Tiger Woods was smart when he told Phil Mickelson, get out of California, stop paying 55% of your income tax in the state of California, and move to Florida.
Yeah. Florida is...
And now Tony Robbins finally, the motivational speaker, finally left California and moved to Fort Lauderdale.
Yep, and you have a lot of prominent people in Florida. And Florida, look, I like what the governor is doing over there. He's trying to promote business in Florida. Okay, Rick Scott, he's trying to do that. And I think that is just, I think it's great because of the, when you're starting up a business, you're not getting hit by every tax under the sun, and it's hard for you to get your head above water. You need to be able to...
There is no state tax.
Right, there is no state tax, and you have a lot of incentives. The one thing, and I spoke about it earlier in the show, John, with private equity. You mentioned startups. Okay, I was talking about the tech industry, how a lot of private equity money has rolled into the tech industry, but it's interesting how this is only with the tech industry, it's not with other industries. With the tech industry, it's like who you know and not what you do for them to fund you. It's interesting.
Right. Well, look at Snapchat. Here's a company that hasn't made $1, and yet they were purchased for $19 billion by Facebook, and that's the new gold rush.
No, that's WhatsApp. WhatsApp was purchased, not
WhatsApp. Right.
Snapchat. Nobody's buying Snapchat.
Well, so the whole tech industry is the new. I like to call it the new gold rush out west. It's been replaced from mining for gold to mining for technology, and all of these companies in Silicon Valley and other areas, people are willing to pay outrageous prices for these companies that are barely making money or not making any money, and they're so enthralled with the prospect of mining for this gold within technology that they lose track of things like PE ratios.
Well, I think that, with this sector, you really can't look at the PE. You have to look at the future of the company. But I guess my point is that you have private equity that, they're going going goo gaga for tech, but it's only on a, who do you know that brought you to us situation. It's not a situation where you have a great product, you have something great, and they're interested in you. The only time that happens if you're already out there and you got your footing. You have a lot of great companies out there that have innovative, disruptive ideas and things to do, but they're not in the valley. They're not in the who do you know that's going to introduce you to funds type of situation, and they fall by the wayside, which is unfortunate. And you have companies like Snapchat that they get this crazy valuation. WhatsApp, as you said, they got purchased for $16 or $17 billion. And then you have other companies that are going to be kind of like hitting, the lotto, because they got introduced by XYZ, and that's the way it's been. And I think that there has to be a change with that.
Well, I've looked at various venture capital firms to talk about growth capital and submitted how our industry is growing and offered a very lucrative opportunity to participate in this industry. And 99.9% of the venture capital firms that I spoke with are no, we don't deal with financial services. It's only technology.
Well, that's interesting, but it's funny how these same private equity firms, funds, and they are looking at tech, but they'll take in submissions, but in order for you to get their blessing or get their money, it has to be, who do you know that I know?
Right. Sure.
So.
Sure.
But it's like just like anything else, you have a cycle with things that are going to happen. And I think that, at the end of the day, whatever cycle it is, what you're doing, John, raising capital for private equity funds, that's not going to get stale.
No, and we have the niche is that we focus on the 100 million to 500 million market that is kicked to the curb by Blackstone, by Credit Suisse, by all those big guys who find those funds not attractive enough, not enough revenue, and typically you're seeing guys like Bob Girardelli left Servius or whatever they call themselves, and they're starting their own firms up, and that kind of guy who ran Chrysler once upon a time no longer has the 5-year track record in the PE markets. He can't, with his new firm, go to Credit Suisse or Blackstone and get the funding for his $200 million fund because he doesn't have a 5-year track record that those guys with their distribution channels require with their investor mandates.
Mm-hmm.
So he's got to come to a guy like me to get funding, and I'm seeing more and more guys like that, from Apollo to Carlyle to Bain to you name it, breaking away, really striking at this gold rush, which is called private equity.
Yeah, and again, when in private equities, what have you done for me lately, or what have you done lately? And if you don't have that track record, they're not looking at you. And it is just funny how once you start becoming that shining star, everybody wants to be your buddy.
Right. Right. But I tell them that, and I've told several people that you're going to find an expensive lesson in private equity, which is not how many funds has the capital raising firm done over the past several years, whatever, 5, 10, whatever number you want to use, one. It's, are their LP investors the best fit for your type of fund? Are they geared towards making the investment in the first-time fund manager? You know, like my distribution channels are specifically geared toward the registered investment advisory market, the fund of funds, the family offices, as well as the sovereign wealth funds. And these guys are ultra high net worth individuals as well as institutions that kind of pride themselves on finding the next Bill Gates or the next Michael Dell. And, they're more willing to invest in those type of emerging managers that do have a previous track record elsewhere, but maybe don't have that track record with the firm they're at now.
Mm-hmm.
And they're much more receptive to investing in their Fund 1 or Fund 2 or Fund 3 without that track record.
Right.
So, I share with these general partners, be very careful with who you choose as your fundraising partner, because some of these firms out there, and I won't mention names, when they get up into the stratosphere of raising 30 capital raises up to 100 per year, and I've insulted many CEOs of private equity firms by telling them,
No, not you, John. You don't insult anyone.
well, I haven't realized I insulted them until after I said to them, it's inevitable when you're doing 30 capital raises and you're boasting on your website that you do 32 or 40 capital raises, or some of the others say they've done 100 capital raises per year, that you're going to have duplicating, competing capital raises, all targeting the same LP investors.
Mm-hmm.
And they say, oh, no, XYZ company would never do that. And I said, you're right. They've got 55 employees or they've got 100 employees, and that decision to support those costs of doing business will never come into consideration when they're looking at a similar private equity real estate fund, where maybe the underlying investments are slightly different. Maybe it boils down to just the incentives for the first close that differentiate the two funds.
Mm.
Or maybe there's energy funds that are similar to each other. But of course, there's going to be a function in which one fund will be more received in the marketplace, better than the other fund, and these guys will tell you, keep your britches on, we're XYZ big firm, bigger is better, we'll get you funded, don't worry. And to me, that's the difference between less is best versus bigger is better.
Right.
And I'd much rather do business the Giorgio Armani way versus the Walmart way.
Right. Because if you can dedicate your time and your efforts and everything you're doing to raising capital the right way for a fund, they're going to get the right investors. And again, private equity fund, who the managers are is what is important. What are they going to do with the money? How are they going to do it? Are they going to be able to? Again, you're not, not all private equity. You're not looking to get a profit, and it's not a day trade. You're not looking to get a profit in a day or in a week or in a month. It may take a couple of years for you to see that, but that's the purpose of private equity. You hold.
I had a group of people in D.C. that I went to see who got some advice from their friends who are principals at a fund of funds, and all they focused on was track record. And I listed now on my website, on one of my pages, the variables that are important. It's the exit strategy, it's the underlying investment, it's the management team. There are several variables that are important to GPs and LPs, or that should be important to GPs, that are important to LPs when they're making those investment choices, and it's not solely based on track record. I told them you're getting information that is narrow and focused both geographically as well as in the marketplace, and I would not put all your money on the advice you get from a fund of funds, because their scope is more limited, because their investors are limited to the people who need that extra layer of risk mitigation, that extra layer of management. And not all institutions will subscribe to that philosophy. So not all LPs are on the same page as people in fund of funds.
Well, you know, they're two different animals, though.
They're right. There's a whole different ball game when it comes to raising capital for certain types of funds, and it's like my brother says. He's a lawyer out in Beverly Hills, and he says I get guys who their best friends are CPAs, and they'll come into my office and tell me, my friend who's a CPA tells me this about the law and that about the law, and he says, wait a minute, let me get this straight. You're going to recite the law to me, a lawyer, from your buddy who's a CPA. and they say, that's right, they're my friend. They wouldn't steer me wrong.
Ignorance is bliss, isn't it?
Right. So there is, placement agents like myself who deal with the emerging manager market are a niche in themselves, and that's where we believe that the tremendous growth is going to be in the emerging manager markets and not in the $1 billion to $9 billion fund market.
Well, look, as I said early in the show, and I've been saying it, I mean, all the times that you've been on the show, you have your fingers on the pulse of the private equity sector. There's no doubt about it. And, I think that it's going to get really interesting as the months go by. And I believe that with what you're doing, because keep in mind, and our listeners should understand this too, is that at one point, all these private equity funds that you see out there, they had to come to someone like you, John, for them to get their funds before they turned into an Andreessen, before they turned into all these other companies that actually blew up out of their investments in tech, Sequoia, things like that, companies like that.
Right.
They had to get their start somewhere, and they raised capital using a placement manager such as yourself.
Well, and the bottom line, Lou, is it's far more cost effective to subcontract out that capital raising to a placement agent like REO Capital than it is to build out an internal investor relations department. The cost factor is a multiple of 3 times greater than it would be to subcontract out that to a firm like mine. And also there is, correct me if I'm wrong, but there's some tax deductibility. I'm not saying it's fully tax deductible, but because we charge a flat fee, and we're charging a fee, there is some deductibility for that expense.
It's an expense. You're paying a consultant to do X, Y, Z, so it is a corporate expense. Yes.
Correct. So there is, there's I think a greater tax deduction than there is if you're building out that internal IR team at your company, and with the cost of training and recruiting and taxes,
you don't have any you don't have depreciation on building out an IR team in a firm. You're actually taking on an expense because you're talking about more space, computers, people, this, that. Health insurance, you have to worry about disability, and everything, it just trickles on and on. So hiring an independent like yourself is, in my opinion, probably the way to go.
Well, I don't think that a lot of these firms would subcontract out that type of work to countries in India, China, and the Philippines, and if it wasn't cheaper to outsource that customer service or that type of
that would be bad.
call center.
That would be bad.
You know.
That would be bad. Just imagine you get a call from someone that can't even speak English, but then they're looking for your money. Oh my God.
Well, there has been people that have called me from India that that were putting together a fund that was looking into the fund of funds or looking to direct investments, and I told them you're going to have a tough sell on your hands.
If you can't relay what you're trying to say, no one's going to bite unless you're doing it in the country and the language that you're doing it. So, yeah, I think you.
Well, and also there's a reputation issue that
for sure.
That India and other countries have now become lack of trusting because there are so many scams going on in those countries that it's really difficult to know who the real investments are and who the fake ones are.
Well, and Ed, I have a new word that I'm using now. Scoundrels.
Yeah.
You have scoundrels all over the place. And over there too. If there's a lack of trust, no one's going to want to do business with you. If you have a lack of trust, I don't care if it's, private equity, don't care if it's real estate, I don't care on either end of the coin, if you're a private equity firm and you don't have trust from the people that invested in you, from the public, you're gonna have a hard road. Same thing with real estate. People don't trust you. If you have a bad rep, you're gonna have a hard way to go. Same thing with, if you're on Wall Street, you have a bad rep, you're going to have a hard way to go. So, reputation is important, and, good thing that your rep is pristine, John.
Well, and I tell people, Lou, it does not make sense for me to take on a capital raise in which I'm not 150% certain that my LP investors are going to subscribe to it. I said, why would I damage my reputation over $300,000 or $400,000 in retainer fees? That would be ludicrous for me just to take on various projects, just to take in the monthly retainer fees, and then fall shy of the ability to complete the project.
Right. You don't want that type of situation on your hands.
It's not worth it for me to damage my reputation over $300,000.
No, it isn't. But John, I think that we went over a lot of things. Your input is always, appreciated and valuable. I know you're gonna have a lot of things going on moving forward, and we're gonna have you, we'll have you on weekly as we normally do, and it's gonna be fun. But before we let you go. Why don't you let our listeners know how to find out more about REO Capital and just find out more about you?
Right. If you go to www.reocapitallllc.com, and I advise the first place to stop is the blog. I've written several articles about the economy, about the capital raising within private equity, the growth of private equity, and there's some very pertinent information that I get from reliable sources such as Preqin and Private Equity International that also have their fingers on the pulse. And I like to educate people on what is going on and post those articles. So that would be my first step.
Excellent. All right. Make sure you go to REOCapitalLLC.com. Find out more about John Dennis of REO Capital. John, thank you so much.
Thanks, Lou.
All right. That was informative, and it's a wrap for this week. Make sure to connect with me on Twitter and Megahoot, and for any and all of your commercial real estate and luxury real estate needs, just go to my website, which is my name, and, just connect. We have a team there that will assist you, and we assist all our clients the best way that we can. All right, until next week, please make sure to follow me on Twitter and give me, you have a suggestion for a guest, definitely, let me know and put them in touch with me. All right, until next week, I wish everyone a profitable week, and just keep rocking and rolling, because life is good and a lot of good things going on as you see where the money flows, and make sure you're flowing in the right direction. Take care.
You're listening to UCW Radio. In your face.
What we got here is a failure to communicate.
Oh, have I got your attention now?
The lack of editor is good.
You know what I mean?
Money to be made in a place like this. Money never sleeps, pal.
You're crazy. Don't run when you lose. Don't whine my head.
You know what it takes to sell real estate?
It takes brass balls.
I'm falling, and I can't get up.